This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Here's a little fun, combative interview I did recently. James Early was kind enough to invite me on his show, and what follows is that interview. I hope you enjoy.
When I was in my mid-30s, I took a push-up boot camp calisthenics class just for fun with a friend. I noticed next door there was this raucous dance exercise class going on. And all my life, I've been afraid of dancing, and I'm not very good at dancing. But I figured I need to get out of my comfort zone. I'm going to go try this thing, the thing that I'm most afraid of. I went way in the back behind this big industrial-sized fan, and I realized I wasn't actually the worst person in the room. There were people worse than me. I got so into it, I ended up starting a dance fitness business myself with one of the instructors. It's a long and weird story, and that is a very weird connection to my interview today, but it is thematically applicable because in the area of investing, I have always been a fundamental analyst. At a hedge fund, when I ran a research department, it was always about fundamental investing, long, short. And today, I'm trying to get out of my comfort zone a little bit. And maybe if you're like me, you can get out of yours a little bit as well. We have someone who is really a world-renowned expert in trend following or momentum investing strategies, to use the academic term. His name is Michael Covel. I saw Michael speak in Las Vegas 4 or 5 years ago and was impressed. And now he's on my own show today. Michael, besides having the trendfollowing.com website and the Trend Following podcast or Trend Following Radio, which has, I think, more than 10 million downloads. He's interviewed Nobel laureates. He's interviewed billionaires. It's really a who's who list of many of the world's best investors and business people. He's also written several best-selling books, including Trend Following, as you might expect, and The Complete Turtle Trader, among others. And he has directed a documentary film called Broke, the New American Dream. This was 10 or 11 years ago. Michael, thank you very much for making the time to speak with me today.
Hey, thanks for having me on.
First question. And by the way, you're the kind of guy who makes me feel like I need to get up and move my butt and get more out of life. I'm really impressed with your resume there. And just for those who don't know, in the background is Ho Chi Minh City. Michael has lived in Vietnam for almost a decade, which I think is pretty cool too. That's something I don't think I would have the temerity or the adventurousness to do. Coming back to investing, how do you get into this field to begin with? And a weird question, if not this field, what else might you have done in your life?
This field. Not sure what this field is exactly, but like most people, when I heard about investing, I heard about Warren Buffett. I heard about Seth Klarman, margin of safety, fundamental analysis. But once I got into that, and I was a little late, my mid-20s, I was like, well, hold on. I don't have the academic chops for this. I've not been trained to study balance sheets and to look at all of this data and information, this nonstop flow of information. And right in the middle of that process of realizing that this was not going to be me, I heard about something called trend following. And I heard about this story of this famous trader in Chicago who had taken kids off the street, literally kids, some teenagers, early 20s. And he was a trend following trader, and he had this set of rules, a set of rules that you could use to trade currencies or interest rates or commodities, energies. Didn't make a difference. Same set of rules and no fundamental analysis. I thought, well, this is really interesting. What's this trend tracking or this trend following system? This was this famous turtle trading story, which a lot of people have heard of. And that just inspired me to go down the rabbit hole. Then I started to realize, well, hold on. There's this whole interesting group of people that have figured out that fundamental analysis is not so specific. And it's not so great when we have the 73, 74 bear market, or the 87 stock crash, or the dot-com implosion, or the Great Recession, or 2022. In fact, fundamental analysis starts to look like, excuse my French here, it starts to look like a sham, a scam even, when you have these market meltdowns, because we're left at the mercy of who? We're left at the mercy of the Fed. However, if you come at the markets with a trend following perspective, you're not trying to predict what's going to happen next. You're just saying, hold on, the price is moving up. Okay, I'm long. The price is going down. Okay, I'm short. And applying this over almost like a venture capital mindset to where you're looking for big unexpected trends, but you're going to have a lot of small losses. For me, after all these years, it's not so controversial, but most people don't get exposed to this. You know this. If you go to school, they hand you a bunch of textbooks written by fine professors at the University of Chicago, and they all say that trend following is impossible. Just copy Warren Buffett. And that's the world we live in. So I'm a fan of this alternative thinking called trend following.
Let me ask you a follow-up then. And I wrote a small piece for people who read my South Bank Investment Daily articles about the turtle trading. It seems almost too good to be true, like a fairy tale. This guy, Richard Dennis, before he was 30 years old, he made several $100 million, I believe, trading in Chicago. He came from humble beginnings. He borrowed money to get a seat on the futures exchange, I believe, and had to have his dad help him. And he had very little, started with like $400. If what I'm reading is accurate, I mean, it seems almost implausible. And then he brought in two groups of people, even some females, which were rare in the trading floor at the time. Not everybody succeeded, but like collectively, they turned like $20 million into $100-something million, which again, just sounds too good to be true. Now, this was 1983, if I'm not mistaken. My question is, A, it sounds like the story is legit.
The story has never stopped. That's the one thing we got to be clear about. Trend following has never stopped. Even if we got rid of the famous turtle trading story, there are so many numbers of world-class trend following traders unaffiliated with each other that have performed decade after decade after decade. And to come back on the challenge to you, maybe too good to be true, maybe if I was to say from March of 2009 until the pandemic, and maybe even this year, 2022, with 0% rates and bubbles and everything under the sun, I don't know. We probably have to have debates about all kinds of things that are too good to be true.
If you look, I mean, there's a debate even among the turtle aficionados or the fans, would this method work today?
Oh, of course it does. In fact, anyone that says the trend following doesn't work today doesn't know what they're talking about, literally, and are probably only taking the opposite side of a book, whatever strategy they're promoting or talking about. Quite simple. I mean, the trend following performance for 2022 is insane. Insane. So yeah, not to push back on you too hard, because I want you to push on me too. But yes, there's not any controversy. The data is freely available for everyone to look at.
Pushing creates diamonds. It's all good. What I was wondering about is, compared to almost 40 years ago, we've got much faster computers. We've just got more people and more quant funds. I mean, there's a lot more money in the market, a lot more aggressive modeling. The idea of something that could be taught in 2 weeks outperforming so well. I mean, these days, it would seem like a computer would pick up on that pretty quickly, and that would be traded away. You're saying it's not, or I mean, it doesn't have to be the exact formula.
This isn't high frequency trading. This is not day trading. So what does a computer do with a weekly bar trading system? Human nature still plays a role here. And human nature says, whether it's JP Morgan or Goldman Sachs or Jim Simons, hey, if we've got enough capital and we've got enough bandwidth close to the exchanges, we're going to play the high frequency trading game all day long. That's not trend following. Trend following is in many ways the opposite of Warren Buffett, but it's very stable. It's not something that's competing with high frequency trading. So computers can only do as good as their masters. And if their masters don't want to trade weekly bars, if their masters are not trying to find trends that might come from nowhere and go on for 6 months, then the computer might not do such a good job of picking that up.
In the short term, just to take your side of the discussion, not that it's even a debate, psychology plays a much bigger role. In the long term, you can't have a business, for example, that's making no earnings forever and adding no economic value to the world forever, right? But that business for a while could still go up if the belief that it is going to go up prevails. Look at GameStop, for example. GameStop is represented in the media as a triumph of the little guy investor banding together. That's true. That happened at the beginning, but after just a few days, the retail traders no longer dominated the trading volume in GameStop. Even during that short squeeze, the institutions fairly quickly picked up on what was going on. They moved in and they started dominating the trading. So in other words, retail investors lit the match. Institutions picked up on it, and you had a trend that went up and went down. Now, this is probably greatly concatenated compared to the types of trends you follow. But my point is, whether it's right or wrong, whether it's logical or not, it happened. Is it safe to say that your trends are longer term, but you don't need to question it? You don't need to understand the fundamentals. You just need to see, look, there's a group psychology movement in effect in something, and it's time to participate. Is that the idea?
Well, GameStop's a great example because GameStop's just this one outlier equity market. Whereas trend following is saying, let's follow the most liquid markets in the world that most every major institution is participating in. Interest rates, currencies, energies, metals, agriculturals, commodities. So I find something like GameStop is simply a media creation, a activist fund creation, some players with some inside information, a game to give the masses something to think about. Whereas something like trend following, a very stable, well thought out approach, again, that's traded over the most liquid markets in the world, an approach that's been traded over these markets for decades upon decades upon decades. And again, as I said earlier, does extremely well when we have overall equity market meltdowns, just a different headspace than a GameStop scenario, in my opinion.
That certainly sounds attractive, doing extremely well during an overall meltdown. Maybe using a past example, could you just walk us through how a trade might work? Let's say you sit down and you're interested in using this system. What are some of the principles? What's maybe an example of this in action?
Well, for example, this year alone, interest rates have been the predominant profit driver for trend following. So what's a simple way, without even naming a market, a simple way to think about trend following? Let's say you've got a group of markets that you're tracking. And again, I've mentioned all the highly liquid ones. You're following these markets and you don't know at the beginning of a year, you can't predict what's going to happen. You don't know what's going to happen. For example, there's a friend of mine, an associate who runs a fund. His fund has been up, I think it's up 80% right now on the year. Now, did he know when 2022 started that that was going to happen? Of course not. He didn't know that all these markets were going to start to move. But if you're in a flat position, if you don't have a position, with trend following, you're waiting for some type of momentum signal. So let's say the market is going flat for 6 months, whatever market it is. It could be a particular interest rate. But then it breaks out. It moves to the upside or downside. You take a position. Now, do you know anything's going to happen next? No. Now what do? Now you're just waiting. You're just waiting to see what happens. Well, that doesn't sound like much control over the market. No control over the market. It's completely saying, I'm at the mercy of the market. Let's see what happens next. Now, you take that position with a stop in place. 2 stops, actually. A stop to get you out if the position goes against you, and a stop to get you out if that market goes for a long trend and eventually peaks and goes the other way. It's not terribly complicated in many ways. But kind of as you've hinted about already, this goes against psychology. Some people don't want to trade like this. They would rather flip on Bloomberg, CNBC, listen to some guru tell them what they think is going to happen. And that's more exciting or more fulfilling. I look at trading, it's kind of about 5 rules, really, whether you're a trend following trader or a fundamental trader. What markets are you going to track? Are you going to track everything? Are you going to track a basket? When are you going to enter? When are you going to exit with a loss? When are you going to exit with a gain? And how much are you going to bet? How much are you going to bet on each trade? I think if you're contrasting and just being intellectually curious here, if we're contrasting between trend following and fundamental analysis, those rules are easy to understand for trend following. The only variable we're looking at is the price movement. That's it. Whereas fundamental analysis is going to say, don't look at the price movement. Let's look at 10 or 20 or 30 other pieces of fundamental information to then predict what the price is going to do. Whereas trend following is saying, I'm not predicting what the price is going to do. I'm just going to follow it. Maybe this helps to clarify for the audience. In many ways, trend following is not in any way, shape, or form a traditional investing or trading strategy. You're literally just trading numbers. It doesn't make a difference what the name of the markets are.
How do you differentiate then? And I think some people watching may wonder, a lot of what you're saying, Michael, would apply, or at least has been said by proponents of technical analysis overall, saying, look, I just need price as my variable. This represents patterns in human psychology. And whether it's right or wrong, I'm not here to argue, but this is how the technical analysts do it. Is trend following a simple version of technical analysis, or is there a thematic difference that's greater than that?
I wrote about this issue for the first time in my first edition of Trend Following. I would say there's two forms of technical analysis. There's a predictive form of technical analysis, and there's a reactive form of technical analysis. Predictive technical analysis would be the people that are talking about the patterns they see in the squiggly lines, about the candlesticks and the dojis and this and that. And they write books with all of the so-called patterns that predict what's going to happen tomorrow. In my mind, that's no different than fundamental analysis. Whereas trend following is a form of technical analysis, but it's reactive. You're simply reacting to the price movement. It's a pretty strong distinction because, I've spent the better part of 20 years ripping to shreds traditional technical analysis. And anyone listening is welcome to hit me up on my challenge. But where are all the performance track records of the great predictive technical analysis traders? Where are these They don't exist. I've looked. One of the things that got me inspired when I first broke into this field, so to speak, was the performance track records of trend following traders. It's such a great illustration of the success that you could find all these different traders from around the world. You could look at their month by month performance data and you could compare and contrast that. That was really interesting information. By comparison, for predictive technical analysis, all the books that we can go find on Amazon right now today, I've never seen a professional track record that's extended for decades from any of that. It's all just book selling stuff.
Interesting. I generally share your view of technical analysis. You mentioned markets. It doesn't really matter. The system could apply in many different markets. It sounds like you would use this system, though, with, if we're talking about equities, an index ETF or some broad-based thing to minimize the idiosyncratic risk. Is that accurate?
Some people say, well, I only want to trade equities as a trend following trader. And then I might well say, okay, if you're going to track, let's say 50 equities or 500 equities, and you're going to wait for a momentum signal, well, how do equities typically move? They typically move lockstep. So the trick with trend following trading is to try to find a group of markets that you're tracking that's not so highly correlated, because that's the real winner, chicken dinner. That's the opportunity, is to find markets that don't typically correlate together. And then that gives you the chance for these outsized moves that come out of nowhere that no one can predict. That's the fun part. That is the alpha generation right there.
Interesting. Uncorrelated then. One more thought. I'm trying to clear out any ammo I could possibly have against this, just for sake of intellectual honesty. In terms of fundamental analysis, an argument that I've often made is that it's good for humanity. It's good for an economy. It's good for the corporate ecosystem to have people trying to actively discern, okay, this is a good business. I want to put capital into this. This is a bad business. I want to deprive it of my capital. And that mechanism is healthy. And is one reason I sometimes worry about index funds, passive indexing, because the criteria for getting investment, if you're in a passive index, is just being in the index. The owner of the index at that point doesn't really care then how good the companies are. They're just buying the index. With trend following, in a world where everybody did trend following, would the overall market be significantly devalued because you just have a lot of volatility versus companies or commodities, whatever it is, being rewarded for underlying fundamentals? By nature, it's sort of an alternative strategy. It cannot exist as a mainstream strategy. Is that accurate?
I think most people are suckers. Let's just be frank. Most people trust what they hear on the TV. They trust what their neighbor says. They trust what their professor says. They give their money to some broker, some IRA or whatever. They never ask a question, and they just go along with the show. They go along with the program, and that's it. When you talk about something like humanity and the good and the bad, we could go back and we could go look at the dot-com bubble. We could say, how great was that we had all of this risk-taking to take advantage of the new internet, and then it blew up. I love the risk-taking. That was great. But when the dot-com bubble blew up, we then bailed out the risk takers. We bailed them out in the form of the real estate bubble that burst in 07, 08, 09. Then what did we do after that? We then dropped rates to 0%, and we got perhaps the bubble that we're living through today. If I was to contrast that with something like trend following, and many trend following traders are rooted in futures trading. They are speculators. Now, anyone that knows something about futures trading knows there's many different types of players in the futures markets. To have a market, you have to have different people with different motivations. You have hedgers, you have speculators. If a hedger could be Cargill or whatever, they've got a lot of strong economic reasons for why futures markets exist. They are there to find a stable price for their product, but they need speculators to show up who are willing to come take the other side, so to speak. And you got to think, when these big events happen, like this year, for example, when interest rates start to go wild, to think about all of the major corporations around the world that have been paying the quote insurance premium, and then they have to reset. That has to go somewhere. Someone's winning in that zero-sum game, and it's trend following traders. So I would argue that trend following is one of those great ideas in the sense that you need speculators in the game. Trend following traders are willing to be speculators. They don't always win, but over the long term, they sure as heck do really, really well. I hope I'm addressing your question. If you want to hit me back, if I missed a part of it, feel free.
I think you are. I think it's accurate. It's hard for one single group to be all the ecosystem. And I think there's nothing wrong with that, to be clear. You need a hedger to match a speculator, generally speaking, if they're taking opposite sides. And many of the people watching this may be more familiar with equities markets, but in the futures markets, it's sort of like a stock option, but it's going to happen for sure. And you're either a hedger, like you don't want to speculate on price movement, you want to factor it out, or you're someone who does. It's the balance of those two things. So I think the corollary in the equity market is it provides liquidity, basically. It provides liquidity, which can be useful. All right. Is there anyone, Michael, you think who should not use this system? If someone came to me to talk about equities, which is the area that I'm most familiar with, I would say, well, maybe I don't know you, but somebody might be suitable for dividend stocks, maybe someone else for biotech stocks, and this person should not do this because it's unsuited to their way of doing things, their temperament, their demeanor, risk tolerance, whatever it is. Who is trend following for and who is it not for, if anyone?
It's an interesting question. And I brought something up a second ago that it reminds me of. And going back to the dot-com bubble, right now, we're all currently alive, and we are living with the remnants of the dot-com bubble, the kicking the can down the road. So it's a very difficult question in the sense that whether I was talking to somebody who's 20 or 30 or 40 or 50 or 60 or 70 or 80 or 90, what's going to happen, for example, if we see another S&P meltdown like we saw by the fall of 2002? Or by March of 2009. What's going to happen to the boomer generation if they're sitting there currently with pretty close to all-time highs of their equity market valuations? Now, I'm not saying this is going to happen, but I'm asking the if-then question. I'm putting it out there to think about it. Can you imagine if the NASDAQ went down 77% from where it is today? Because in the fall of 2002, the NASDAQ was down 77%. So now I have to ask Mr. and Mrs. Baby Boomer, can you imagine going down 77%? Most people can't, because we've had this crazy, unusual run of Fed intervention over the last 22 years that people want, and this is kind of inherent in your question, they want something predictable. They want something consistent. They want something that's going to be easy, that's going to relax their mind and let them feel okay. But who, if they just at least pinch themselves right now, who feels okay with the current environment? Look around the world. My gosh, China is so opaque right now. You mentioned how many times you've been there. I doubt right now you have a really good handle on what's going on there. I don't think anyone does. And then you look at the currency devaluation across the world. You look at the dollar strength. You look at the Fed chief saying, hey, implying I'm going to be Paul Volcker all over again. And then back to my point, can you imagine 50% drops in stocks again for the boomer generation? It's a really interesting time in the sense that there is no one size fits all, but in some ways, everyone that's alive is in the same predicament, especially if they have money in the markets. They're in the same predicament because you're just trusting that these people that we see on the TV are going to fix it all, that they're going to solve it all. What if they can't? What if they don't? A lot of Americans, for example, probably don't think about Japanese equities. Why can't America go the route of Japanese equities down almost 50%, 30 plus years later? Anything's possible. And again, I guess this is another reason why I like the trend following perspective, because anything is possible. And to also address your point a little bit more, can anyone do it? Maybe not. Maybe most people, even if they were to suffer a 50% or greater drawdown in their typical stock mutual fund, maybe that's the best they can do mentally, because maybe they've gone their whole life trusting the system and that's all they can do. Maybe they can't do more than that because it's just too stressful to think about. However, for those adventuresome sorts out there that say, I really don't trust this system. I feel like I need something on my side to give me a chance to at least get some hedge to my current market positions and life. Trend following is something interesting. It's a rabbit hole to go down, that's for sure.
I think the normal portfolio guidance would be, hopefully, Mr. and Mrs. Baby Boomer wouldn't put all their money in the NASDAQ. They wouldn't go down 70-something%, and they would have a 5-year time horizon, at least for equity. So hopefully that bounces back up during that time. And by the way, historically, big market crashes have been followed by rebounds for the most part in the US. But you brought up a great point, Michael, which is it may not always happen. It didn't happen for Japan. I mean, Japan has been waiting for that rebound for almost 30 years now, right? More than 30 years.
How long did it take for the NASDAQ to get back to its before .com crash highs? It took a while. It's over a decade.
Yeah, it did. Certain individual stocks recovered faster, but I think NASDAQ writ large took about a decade. Yeah. And there were some, like Microsoft, there were many individual names too that did take also a decade to earn back into their valuations.
You bring up the idea of the boomers and perhaps NASDAQ markets, but what boomer out there now doesn't have a piece of Apple? I mean, the guys over in Omaha, the most famous fundamental guys, have got Apple.
And it's been one of their best investments.
Right. But I mean, okay, that would be a NASDAQ stock, right?
Yeah, so true. So if one of these boomers or someone in the World War II generation, anybody listening says, wow, okay, this is cool, I'd like to learn more. Michael, where would you recommend they start? Obviously, they can go to your website, trendfollowing.com as one option. Where else?
The Beast.
There we go.
The Beast. And the Small Beast.
Awesome.
Yeah, I'm easy to find. It's actually a good filter. If people can't find me, it's probably better that they don't find me. Right?
I think that makes sense. Yeah.
Right.
Covel, the name is easy enough to spell. So if you're interested, watching at home, please check out Michael's website or his books or his podcast. Plenty of resources, as he mentioned. Michael Covel, thank you very much for joining us today, or your nighttime in Vietnam. And thanks to you guys for watching at home.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.